I think there is some interesting market link pieces that we have in the session today on Editor's Cut. Alex, what do we have?
Neeraj, morning, and a good morning to everybody tuning in as well. Just a quick heads up, if you're tuning in to this particular segment of India Market Open for the first time, then this is meant to get you beyond the headlines. And today, in fact, we're talking about key data, as Neeraj pointed out, that may suggest, and I'm saying this with a lot of caution, it may suggest that the uptick in mid-cap and small caps may just be in the last leg. Hiral is going to take you through some of that. At the same time, we're talking about PSU banks and why the uptick there is not necessarily over. In fact, it may just be starting based on the data that Neeraj has gotten together. Hiral, let's start with that. Of course, the caveat is that you can not necessarily tell what is going to happen from here on out based on cycles in the past, but then history tends to repeat itself.
Absolutely. History does tend to repeat itself because if you see the previous cycles in terms of the broader markets, what is coming out right now is, the key question is whether the mid-cap and the small-cap companies and index is probably in their last leg of the catch-up and outperformance that we've seen so far. Because clearly, if you go to see the 5-year outperformance as well as the 10-year outperformance, that is something which has been surpassed. Let's quickly look at the screens right now. If you see Nifty, we've seen a YTD growth of around 18% versus the 5-year and the 10-year, which was in that range of around 13 to 14%. Similarly, in terms of the mid-cap and small-cap, it's very interesting because your YTD is around 42 to 46%. Whereas if you see the 5-year annualized performance and the 10-year annualized performance, that's in that range of around 19 to 21%, right? So this is clearly telling you that right now there is that outperformance that has come in the first leg. Now from here on, what are valuations suggesting to this? From a valuation perspective, and I'll want Neeraj to come in on this one as well, clearly you've seen that the mid-cap valuation now is at a historical peak. And this is if you remove the COVID year, which is the 2021 year. The current for the mid-cap is around 24.2 times. 2017 peak was around 24.5 times, right? Similarly, small cap current is around 29.3 times, whereas the 2017 peak is 18.3 times. So one way the valuation has already surpassed the peak that we were looking at, and the outperformance has already come in. So that's going to be crucial from here on, whether for how long is this rally going to continue, the duration becomes absolutely important.
Absolutely. Neeraj, do you want to come in on that valuation piece?
No, just that, so the small cap index valuation would be a factor of what everybody estimates it to be, but largely the numbers vary between 26, 27 times to 32 times. So let's say an average of maybe 30, let's say. Now, are these historical peaks? They certainly are, and therefore, it's not a completely unwise piece to assume that we've gone to near frenzy levels, especially in the IPO markets and even in the mid-cap end of the market, and therefore the last leg of the rally at that end. The only question is, structurally, we are so strong that will dips be bought into? That's the question that comes in. But it's great, Alex. I think Hiral is done.
Absolutely.
This data working that Hiral and Jim have done is great.
In fact, there's more data. And I just a small point on this. I wonder, and we'll have to look at fund holding in the broader end of the spectrum. I wonder if the multiples that are currently being ascribed to the small cap space also to a certain extent has to do with the flow of retail money through mutual funds, and we're talking about participation through mutual funds of retail investors at a peak level never before. We're talking about 38,000 crore that has gone into actively managed small cap funds in the year to date, which is significant.
One thing what I want to add over here is, if you see the trend of FIs as well as the DIIs in the mutual fund industry, the FI investments into small caps are weaning off. It's the retail and the DIs, the domestic players, who are increasing their flows as well in terms of the small cap funds, right?
Goes with the 38,000 crore
exactly.
number.
Yeah,
so it goes with that.
And the breadth of that, because at the broader end of the spectrum, you're talking about lower floats, you're talking about liquidity being an issue. So you're seeing fund managers go wider than they have in the past. So you kind of spread the wealth in that sense.
Yeah.
Let's
So,
see that.
so what's the net call here? Sorry, Alex, you want to?
Yeah, no, so a little bit more data, and I'll quickly run through this. The average run over the last, and we're talking about 3-year cycles here, so 2021, 2017, and 2014, right? The average cycle, and let's pull that graphic up, Nifty 50 currently up 40.9% in the year to date, mid-cap and small-cap around 73% and 77%. The average for the last several cycles is 62% for the Nifty 50, 88% for the mid-cap index, around that same level for small-cap index. But for the small-cap index, we're already past the last cycle, and we're very close to the gain that you saw from trough to peak in the 2017 cycle.
But still away, right? Because
it's
the
still a
average
little
price is
bit.
87
Yes.
and
Yeah,
currently
so
is
it's
77.
skewed just a little bit.
So, and that's the reason why that probably this is the last leg, what probably investors could start
And
looking
the
at
very
as well.
last
Really cool
element,
data, by the way.
very last element is the duration of the run from trough to peak, and the current run is 18 months, which is just higher than one of the last 3 cycles, and that was the cycle in 2013-14, which was 15 months. The 2018 to 21 cycle was as much as 43 months and the longest, and the one before that was 27 months. So from that perspective, you know, there's still some ways to go, but then, you know, like Hira is saying, last leg.
Yeah, sorry, 18 to, just one point, 18 to 21 is a bit debatable because it had a COVID period, and I think there was a very bad period for small caps in that period. But yeah, largely it seems 18 months is at par.
If you
or maybe
take the
slightly.
average also of around 28 months, we're still
below.
10 months below the average. And if you, very quickly, if you just see the Nifty 50 stocks, which are still below their 3-year and 5-year average PE, you have names like Dr. Reddy's, Apollo Hospitals, Bajaj Finance, HUL, UPL, and 4 banks, ICICI, HDFC, SBI, and Kotak, right? So there are private banking names and PSU banking names, but that probably will take us to the second part of the piece as to what's happening with the banking
Absolutely.
counters.
And in fact, the data that you've put together, Neeraj, on the PSU banking space, right? The recent run-up has kind of been driven by this pack, hasn't it? The question is, how far will it go?
Yeah, so actually it's not just the recent run-up. There is an index, and I'll make this quick now because I know people are waiting for the derivative segment, so we don't want to delay that. But from 2020 till 2023, a gauge of PSU banks index has beaten the performance of the private bank index, not by a country mile, but quite significantly. So PSU banks largely have done well, but they've seen a recent bit of a pullback aside of what happened yesterday. Now, the question that we are asking is, can PSU banks still continue to do well or bounce back from the hit that they took in Wednesday's session, right? Maybe we are doing this a day late. Maybe we would have done this yesterday because yesterday the banks did bounce back. The pluses, most PSBs are well capitalized. There's a strong earnings turnaround that we've seen in the PSU banks since FY21, late 2021 or thereabouts. So the last 18 months have been very, very strong for the PSU banks. If you just look at the ROA uptake, if you just look at what they've done on the NIMs, on the PAT, etc., that has been very well, done very well too. You know, except maybe one, you know, PNB, but most of this one are now above that 1% ROA mark as well, or around that 1% ROA mark, which is great. LCR is above the regulatory requirement, which is a great thing as well. You know, the risk-weighted assets notwithstanding, I don't think it impacts too much. We don't have time to get into detail, but I don't think it impacts too much. But the other key point is that all of them have done a recent fundraise, maybe in some cases to comply with the regulatory
And they
uh,
have
framework.
strengthened their balance sheets.
They have strengthened their balance sheet, done fundraise. Now this augurs very well when, if we believe that the capex cycle is going to start meaningfully, government has happened, private capex will start, who will lend? It's the
It has to
PSU
be the
banks.
So the post-election phase is going to be spectacular for these companies. And Neeraj, you know, an SBI, undervalued completely.
Still.
In fact, exactly. And you do, I mean, recently you have a lot of brokerages which are now clearly spotting it out, saying that our PSUs underrated, and is there a re-rating that could be on the cards?
Yeah, I mean, and you know, some would argue that Ramesh Damani, Samir Arora have played this very well, but maybe there is more in store. So that's a valid point. What, just very quickly, what ails the PSU banks? I mean, one, historical bias, because if you've seen the 2010, 2020 cycle, you'll be like, yeah, you know, we've seen this before, it'll falter. Maybe it won't. Right? So that is the one point. And the second point, there is a possibility that higher credit cost may impact the quantum of PAT growth going ahead as well. So that is to be kept in mind. Provisions are there, maybe they impact as well, and credit cost may impact. So that's one caveat to keep in mind. But the last point that I want to make on this is that if you just look at the divergence between what the PSU banks are saying and what the market is thinking of, the market in all the notes that, or largely the notes that you've seen, everybody's thinking of the ROA is being about 1%, and the estimates are based on that. Banks largely are guiding for 1.2.
Yeah.
Right. So if they indeed achieve that
and overachieve, basically.
Then there is an upside.
Small last point, small, very small, and we're talking about PSU so far, but we must remember that based on the current regulations, the engine of growth or lending growth for private sector banks, which has been on the retail side, might just get hit. And so from that context, if you want to participate in lenders, then where do you look?
Maybe PSU banks.
There you go. All right. So what do you think about the two topics that we've discussed today? Don't forget to write to us on any one of our social media platforms. As Neeraj pointed out.